Ladies and gentlemen, the central banks have just made a huge mistake. And yes, while they've made many mistakes in the past, this may be the biggest mistake yet, and we're all about to pay the price. Also, the Federal Reserve is actually covering something up. They've been lying about something that they were meant to be doing right now, but they're not. So this big mistake they just made today, and also the lies that they're trying to cover up, is going to have severe consequences for us all. So you all need to prepare right now, which I'll also get into later in the video. So everyone, what was this mistake? What lies are they trying to cover up? What new data do we have? Well, that's exactly what we want to go over in today's video. So let's not waste any time. Let's get straight into it. Okay, first things first, this is the first mistake, everyone, but there's many more to come. Fed Chair Powell says inflation is starting to ease, but interest rates are still likely to rise. So what Jerome Powell has done today is he's completely confusing the markets. He's sending mixed signals. He's saying, don't worry, inflation's coming down, which is leading to many people to think he's going to pivot. But then on the other hand, he's saying, well, inflation is still high, so we're still going to lift interest rates. So what is it, Jerome? Is inflation done? Is it going down? Or is it still too high and we still need to lift rates? This is the mixed message he's sending right now. It's confusing the markets. The markets think it's time to rally, but unfortunately, I think there is still going to be more rate hikes. I think the Federal Reserve is going to be wrong. Remember what they said, don't worry, there'll only be a few rate hikes in 2022. Well, they actually did much more than a few rate hikes. Remember when they said, don't worry, inflation's transitory? They're wrong about that. Then they said inflation's peaked. They're wrong about that. And I think they're going to be wrong again by thinking that inflation is going to absolutely plummet this year. Yes, it may go down a little bit, but it's still going to be above trend for much longer than they're talking about. So the Federal Reserve Chairman Jerome Powell said Tuesday that disinflation has begun, but it's going to take time. So again, they're saying disinflation has begun, but we're not going to have disinflation yet. Because I don't know about you, but I'm still seeing items very, very expensive. Yes, maybe prices aren't going up as much as they were before, but prices still are severely elevated. So the markets, again, getting mixed signals. The markets latched onto Powell's words and briefly turned positive before flipping back into negative territory after he cautioned about stronger than expected economic data. So again, we saw a lot of whiplash in the markets today. They recently rallied when he says that inflation's easing, then they dropped a bit about strong economic data, and then the markets closed higher. He said if we continue to get, for example, strong labor market reports or higher inflation reports, it may well be the case that we have to do more and raise rates more than is priced in, he said. So if he knows the job is not done, if he knows more rate hikes are going to be coming, he shouldn't be giving any hints at all that there's going to be disinflation, because what this does is it loosens financial conditions. What we saw with oil today, oil surged around 3%, so then that can make inflation surge higher again. If he starts to talk about, hey, inflation's going down, we're about to pump a lot of money into the markets, everyone goes there and buys up stocks surge, they take their profits and go out there and spend their profits, has a positive wealth effect, and it could mean that all their work they've tried to do to bring inflation down could be undone. And this is what central banks did in the 70s, and that's why they had to bring Paul Volcker in to give a clear message, no, we're going to absolutely crush inflation until the job's done. Because one of his colleagues is saying rates are going to have to go much higher. Fed's Neil Kashkari says central bank has not made enough progress and is keeping its rate outlook. And listen to what he says interest rates are going to have to go to. That means continuing to raise interest rates as he sees a likelihood that the Fed's benchmark borrowing rate should rise to 5.4% from its current target range of 4.5% to 4.7%. So everyone, what he's indicating here is interest rates need to go up another 1%. Now, I think this is exactly bang on. For example, if they lift interest rates every single month to 5.5%, and if hopefully the next CPI reports come in a little bit lower, and then inflation drops and they bring interest rates up to meet the declining inflation rate, that's when they can get control of inflation. But if all of a sudden they pause this and say, you know what, disinflation's happening, well, what's going to happen? The market's going to pump money in, people are going to spend like crazy, and then inflation is going to get away again. So the markets are getting a mixed signal here. They're thinking and they're hoping that the Federal Reserve is going to pivot at the next meeting or the following meeting and actually going to start cutting rates this year. But if they don't get that, if the next CPI report comes in that we get next week hot, we're going to see the market sell off rapidly. But the markets is just looking at interest rates. Are they forgetting something? Quantitative tightening, where the Federal Reserve sells assets on their balance sheet, mortgage-backed securities and US Treasuries. Well, have you been paying attention to what is actually happening to the Federal Reserve's balance sheet? And this is something I don't see the media reporting about at all. the Federal Reserve is actually not selling the amount of mortgage-backed securities that they said they would. Look at this. So how fast is the Fed winding down its bloated balance sheet versus the planned maximum? So look at this chart here. We can see the Federal Reserve's balance sheet hit a peak of around 8.9 trillion in April 2022, and it's now fallen to 8.4 trillion. But what we really want to look at is mortgage-backed securities. They hit a peak of 2.74 trillion, and they've only dropped 115 billion to 2.62 trillion. But let's do some quick math here. The Federal Reserve was first meant to sell 17.5 billion of mortgage-backed securities, and then after 3 months increased that to 35 billion. So when QE ended, the Fed reinvested any maturing securities to maintain the size of its balance sheet. With QT, the Fed stopped reinvesting up to 30 billion in maturing treasuries and 17.5 billion in maturing mortgage-backed securities every month, passively shrinking its assets as those securities roll off without being replaced. Those caps rose to 60 billion and 35 billion respectively in September. So again, at that viewpoint, we had 3 months of the lower QT and then 5 months of the higher QT where they're meant to be selling 35 billion worth of mortgage-backed securities. But like what we saw with that chart, their balance sheet only went from 2.74 trillion to 2.62 trillion. That means they've only let 115 billion worth of mortgage-backed securities mature. That's only 50% of what was meant to happen. So why are they doing this, everyone? But before we get into that, you guys need to hear about today's video sponsor, ITM Trading. I've been getting a ton of questions from you guys where I think is a safe, secure way to buy gold and silver. But not only buy gold and silver, have a white glove service when you're buying gold and silver, and also teach you about the gold and silver markets and give you a custom tailored strategy for your specific goals. Well, that's where I'm proud to work with today's video sponsor, ITM Trading. ITM Trading is a precious metals company that's been in business for over 27 years with a mission to educate and empower individuals to hedge against inflation, mitigate financial risk, and prepare for what we've been talking about extensively on the channel, the Great Reset. And they specialize in the physical, real gold and silver, and they ship only to US addresses or vaults. And they offer custom portfolio strategies for their clients which have historically proven to protect wealth and assets, specifically during economic downturns or currency collapses. And what I like about ITM Trading is they prioritize relationships over transactions and provide, like I said, white glove service. They also guarantee the authenticity of their rare coins and go the extra mile and buy only sight-seen certified coins. You may have watched YouTube videos or heard about the chief market analyst Lynette Zhang, whose research I greatly respect. And today you can book a free, no pressure consultation with market analysts who have 25 years of experience. And the aspect of the ITM Trading business model that impressed me the most is what they're actually doing on YouTube is teaching financial literacy for free and putting it in simple layman terms. So if you're currently positioned in dollar denominated assets somewhere in the financial markets, or you're in crypto or already own gold and silver but want to expand your knowledge, it would be a very wise decision to give ITM a call today. I'll also provide a link in the description below, and again you can call the number on the screen now. Now back to the content. Well, the reason why they're doing this is because of the surge in interest rates, which has meant mortgage refinancing has been non-existent. And on top of this, home sales are in the gutter. Look at this, existing home sales declined for the 11th straight month and they're down 38% since January. So what this means is there's not actually enough housing transactions for the Federal Reserve to wind down this balance sheet unless they want to cause interest rates to spike and cause these mortgage-backed securities to lose huge amounts of value. So again, this is absolutely insane. The Federal Reserve is not doing what they're meant to do because they don't want the markets to crash. Because we just got more data to show us what is happening now with house prices. Look at this, Black Knight Mortgage Monitor. Home prices declined in December and they're now down 5.3% since June. So on top of all of this, house prices are now starting to fall. This is just a national average of 5.3%. There's many areas like the Bay Area, for example, that are down over 20%. This is just a national average. You have to get down granular to your suburb to see what's happening in prices in your area. But the housing market is facing significant risk. But people, that's not the worst of it. Look what's happening with the banks right now. So banks borrow unsecured cash at record clip while deposits flee. So deposits at US lenders fell in 2 consecutive quarters last year for the first time in over a decade. So remember in 2020, 2021, the banks had record amounts of deposits put in because of all the stimulus checks and all the money that was being printed. They didn't even know what to do with how much money they were getting. Well, now deposits are fleeing, maybe because of the awareness. People are starting to know that their money is not safe in the banks. I'm seeing a lot more YouTubers doing videos on how your money is not safe in the banks. So I'm sure a lot more customers are taking their money out. Maybe they're buying gold and silver, which I'll get into later in the video. And so banks are having to borrow unsecured cash to keep up their reserves. This is a very, very alarming trend, everyone. And what I think ultimately is going to happen is a central bank digital currency, because they're not going to be able to stop the next crash by traditional terms. They're going to need to take a currency. The US government is going to be bankrupt, so they're not going to have enough money to give out stimulus checks. So they're going to bribe you with $1,000 to create an account, but really what they're doing is just paying to surveillance you. Look at this, central bank digital currencies would bring hyperinflation. That's right, everyone. Can you imagine if everything was digital? All money was just on your phone, and then all of a sudden if a recession hit, instead of having to wait for your stimulus checks to come in the mail, within seconds everybody could get $1,000, $5,000 in your phone, in your account. And you may think, oh, that sounds great. Well, we all saw what happened to inflation with the stimulus checks. All it did is it just made the cost of living go up even higher. So people thought, great, I'm getting free money. Well, now we're all paying the price for it with everything much more expensive. And because people get the money even faster, inflation would come even faster as well. Because I'm not sure if you knew this, but back in the day, they actually used to record inflation not by prices going up, but actually how much the money supply increased. Central banks know that inflation is really a monetary phenomenon. They print money to stimulate the economy during recession when we're having deflation, if they thought that printing money had no consequences on inflation. They know that it creates inflation, but they're trying to cover up. And now what they're doing with the new BLS report, is they're trying to hide the inflation by changing the way they calculate it yet again. They did this in the 80s, the 90s. They're going to do it again to try to cover up the inflation, because we're in a debt-based system, and the US government isn't going to be able to afford to repay their debt unless they inflate away the debt. But one of the most alarming things for me about a central bank digital currency, what are we seeing with central banks right now? They're becoming more and more political. They're becoming more and more politicized. They're meant to be independent from politics, but we all know they're not. So what they could do is send you money, but say, you know what, you have to spend in this industries, maybe in green industries. You can't spend it on the big evil oil and gas companies. You have to spend it in this area by this date or your money expire. And if all of a sudden you fund a cause that they don't like what happened with the truckers in Canada, well, your account will be wiped out like that. So this is why we can't let these central banks digital currencies happen, people, because once we lose that monetary freedom, it will be gone forever. And do you know what I think is going to happen? They're going to take this fake money, and what they are doing right now, they're going to use it to buy real money. That is gold and silver. And we've got the data to show that they're doing it. Look at this. So gold demand has surged to an 11-year high in 2022 on colossal central bank buying. So if central banks are saying don't buy gold, it's a bad investment, it's just a relic, you can look there and hold it, but it doesn't, earn you any income, there's no reason to buy it. Well, why are they buying it at record pace? So listen to this. Annual gold demand jumped 18% to 4,741 tons, excluding over-the-counter or OTC trading. So that's the largest annual figure since 2011, fueled by record buying in the fourth quarter. So more towards the end of 2022, they went on a spending frenzy, and I think they're going to continue to do that in 2023 because they know the geopolitical environment is going to get worse. And if central banks don't win the fight of inflation, well, gold and silver is going to skyrocket, and they're going to retain its value while the US dollar plummets. Listen to this. Key to the surge was a 55-year high of 1,136 tons brought by central banks across the year. So that's right, everyone. Central banks have never brought this much gold since 1971, when the central bank went off the gold standard. Why do you think this is? Well, what I think this is because we all know central bank digital currency is going to be coming. They're going to inflate away their debt because there's no other way they can pay it. And they're going to want to have the real money, real cash. And the government and the central bank that has the most gold is going to be the wealthiest after we have this next global conflict and the next fight for which country is going to have world reserve currency status. Because remember, the WEF said the US won't be the world's superpower by 2030. So why are they buying, and which central banks are buying the most? So there's a group annual survey of policymakers revealed that the key driver behind holding gold were its performance during times times of crisis and its role as long-term source of value. So they're saying they're buying it because it performed well during a time of crisis. So what crisis is going to be coming that we don't know about yet? So in a year that's been scarred by geopolitical uncertainty and rampant inflation, central banks opted to continue adding to gold to their coffers and at an accelerated pace. The majority of central banks buying in 2022 came from emerging markets, with the Central Bank of Turkey the largest buyer with a record 542 tons, China, then India, Egypt, Qatar, Iraq, the UAE, and Oman. So the trend what I'm starting to see here, everyone, is the West is selling and getting rid of their gold while the East is buying it up, probably because they want to rise out of this next global conflict as the next monetary superpower. So everyone, I know what you're thinking, well, okay, what does all this mean for you in simple terms? Well, what this means is we have a risk of central bank making yet another huge mistake of telling people that inflation is going down by taking their foot off the gas, by trying to bring inflation down and inflation surging higher. They're lying to us about what they're doing with mortgage-backed securities. They're not selling them. Banks are having to borrow unsecured cash at record pace. We have a risk that they could create a central bank digital currency very soon and print money like crazy, and we experience hyperinflation. And a central bank's preparing for this by buying gold, and that's what I'm doing as well. I'm dollar cost averaging into gold to protect against this risk of my purchasing power getting absolutely decimated. But everyone, this is just what I'm doing. I'm not telling you, you have to do this. You have to figure out what's best for your own personal situation. So everyone, what do you think about all of this? Let me know down below. Now, for all my loyal viewers and subscribers still watching, you're awesome. Thanks for watching. I'll see you all in the next video.